Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to this special discussion on the impact of the Il&fs Group's default on financial markets and the banking system. I'm Latha Venkatesh. Well, in August this year, this infrastructure financier, Il&fs, with a 93,000 crore exposure to financial markets and banks, defaulted on one of its commercial paper. And this month, it defaulted on its intercorporate deposit. Rating agency ICRA downgraded some of the loans of the Il&fs Group from AA+ in August to D, all in a space of 2 weeks. Probably because of this, risk aversion crept into the debt market, and on Wednesday, one fund, DSP, sold its investment in DHFL's debentures at an 11% yield, a little above what the market was willing to say is a usual level for that paper. This news led to fears that NBFCs generally could find it difficult to get funding and roll over their CPs. Their stocks fell sharply. Over the next half hour, we are going to take a closer look at whether and how the Il&fs issue could lead to greater problems in the debt markets and the NBFC sectors. Joining us are Amandeep Chopra, Group President and Head of Fixed Income at UTI Mutual Fund, Shrikant Vadlamani, the Vice President, Financial Institutions Group at Moody's Investors Services, and Lakshmi Iyer, the Chief Investment Officer, Debt and Head Product of Kotak Asset Management Company. Gentlemen and lady, welcome to the show. First up, Amandeep, am I connecting the right dots? The Il&fs event default to the sale of a DHFL at well above market yields.
So, Latha, I guess, there is some degree of relationship over there. I think DSP has come on your channel to say that the Il&fs default and the markdown that they had to undertake did create a bit of, redemption pressure, which they had to meet by generating liquidity, which also then culminated in, having to sell other securities within the portfolio. Now, we do understand that the bond markets are relatively tighter than, what they were a couple of months ago. This has clearly been driven partly by, the tightening that we've seen from the central bank, and also a degree of risk aversion as far as, new investments are concerned. So I think in that backdrop, one would expect the spreads to widen, and maybe when you do need liquidity in a very quick manner and you have to sell an asset, you actually, are entering a buyer's market. And I think that is a backdrop where possibly, you could have seen selling at levels which would be much higher than what ordinarily, a typical bond like this would have.
Ordinarily, what would it have gone for?
I think ordinarily one would have expected the bond to yield trade somewhere between 10 quarter.
Okay, all right. So that's the cup that of yield that you the fund had to give. Lakshmi, let me come to you on a similar issue. At the heyday of mutual funds and NBFCs, that is all through 2017, a lot of mutual funds launched that Credit Opportunities Fund, which they very clearly said was a high-yield kind of fund, though it was a fixed income fund. And SEBI actually even asked these funds to change the name from Credit Opportunity to Credit Risk. Now, do you think that there could be a problem in this fund, that a lot of people may have invested and they want redemptions, and therefore these funds are forced to sell?
So, Latha, the beauty of the situation that we are witnessing today, whether it was a month back as you introduced just at the beginning of the show for Il&fs, or it is for Divan, or some of the other NBFCs where the market caps have got eroded in the equity market, specifically those in the listed space. Interestingly, if you map the ratings of their debenture outstanding, it's actually AAA. So we are really not talking about these entities actually qualifying as a credit, risk category. But of course, you may have those as an investment, universe. So the point I'm trying to make is that in this kind of a market, when the liquidity genuinely is tight because of advanced tax outflow, and it gets compounded by a situation like this, why would even a liquid fund be spared? So I don't think credit risk fund also would be an exception. The only saving grace is that you need to make these investments for a minimum of 3 years if you want to avail of long-term capital gains tax. So therefore, and then the second reason that bulk of this money in the industry is retail and sticky money, the tendency of outflow may not be as fast as could it be for some of the liquid and ultra short-term category funds. But clearly this is not a credit scare which is leading to a panic, but more of a liquidity-driven selling pressure which is accentuating the panic in the market.
Yeah, a liquidity scare can become a solvency issue if it is not attended to. And we have seen that play out in debt markets over and over again. Shrikant Vadlamani, before I come to that, whether, a liquidity scare can become a solvency issue, I want to ask you whether this Il&fs downgrade is not just only one. That may be something that is playing on the market's mind, that something which was actually AA plus was not really AA plus. The yield indicated that. Although Il&fs was, rated as AA, even in August and before that, it was not trading at a yield of under 10. It was yielding higher. So the market's fear is maybe there are other high-rated paper which don't deserve to be. Is that a legitimate fear?
Sure. I think that's a very good question, because that's probably an indicator of how sustainable or how permanent the issues that have surfaced out in the last 2 days are. And I think the answer reassuringly is no. I mean, if you look at the broader finance company sector in India, we're talking about players predominant in retail. I mean, the ones that have been prominent in the last 2 days are in mortgage finance. And the contrast between what's happening in infrastructure financing, which is where Il&fs is, and what's happening in terms of the broader retail market can't be starker.
Yes.
So, in fact, this has been the best performing segment as far as the credit metrics are concerned.
Okay.
Of course, we do have concerns that there is some froth building up in retail, but that's more of a cyclical correction. So, when we look at the broader solvency metrics, clearly, I don't think there should be any cause of concern on the retail financiers.
Okay. Well, I think that's a very clarion statement that you're making, that problems of Il&fs, which are a huge asset liability mismatch because they lend to infrastructure, cannot be compared to companies like DHFL or Indiabulls, who are largely retail financiers, and therefore the market is probably unnecessarily scared. Would you agree, Amandeep?
So, Latha, if you remember in one of your earlier programs, I had mentioned that the financial conditions today are much tighter. So a typical AAA NBFC today is borrowing at almost 120 basis points higher than where we were, beginning of this year, and about 180 basis points over, same time last year. So I think some of that is bound to spill over into two things. One is a gradual, slowdown as far as incremental growth is concerned. Because, a lot of growth that we've seen of late is retail/consumption driven, demand. So that clearly is impacted by higher cost of, borrowing.
Yeah.
And secondly, I guess even in terms of, the margins and ability to grow the balance sheet at the same size as you were doing 12 months ago is going to be impacted. So I think a lot of that is now going to be seen in the way, you will have some of these entities growing going forward. But again, you were talking earlier about the stock market reaction.
Yeah.
Like I mentioned, year to date, you've seen cost of funding go by 120 basis points. I don't think the stocks really factored that in.
Yep.
So clearly there was some element of realization that, it is going to become a little bit more difficult to sustain the same level of growth when you have such higher cost of funding, and also it's going to sort of, maybe, lead to some bit of compression as far as your margins are concerned going ahead. And I think that realization possibly could have reflected, combined with some of these, specific events.
So correctly price the debentures of NBFC companies, and more importantly, correctly price the shares of some of these lenders. They are probably given more higher valuation than they probably deserve. Yeah, some of them went up to even 8 times at one point in time. I take a point on that. I have to take a quick break, but we want to discuss the IL&fs issue in greater detail. Are there more ramifications and wider implications of this default, and how should it be resolved and resolved quickly? In a minute, I'm coming back, and I also have a big man giving me his opinion on IL&fs.
ILFS is from the contagion effect point of view, yes, it is a risk, but for every problem there is a resolution, and I am sure that the board, the management, the shareholders of ILFS and its subsidiary companies, they will be putting their head together and work out a solution.
So should we expect a resolution very soon? No, I mean, one fear is that after September 30th, will it become an NPA?
Why will it become NPA after 30? 90 days norm will still apply. But what I'm saying is that if you look my answer to the previous question, time has lot of value. So anything and everything in respect of any asset which gets stressed, the resolution has to be fast, and there are decisions, there are ways through which a resolution of any asset will happen, and that is possible.
Exactly, sir. Because time is of the essence in this, can we expect a resolution quickly? Like, can it come next week?
I have to say the government has a very limited role in this to play. It is ultimately the creditors who have lent money to the ILFS and its subsidiaries, and the board and the management of these subsidiaries of ILFS and ILFS to sit and find a resolution.
But Mr. Rajneesh Kumar, the short-term loans are very high. It's, under 1 year loans, I believe, are as high as 20,000 crores or even more. Can shareholders, that is, LIC, Oryx, HDFC and Due, bring in that much money? I mean, if the government is not going to be part.
We must wait for the resolution plan to be prepared and submitted and evaluated.
See, Srikanth Vadlamani, I want you to come in on this. The way Mr. Rajneesh Kumar is himself a shareholder, they are not talking about shareholders bringing in the money. There is a meeting on September 29th, board meeting. If LIC and HDFC, and you can't even tell Oryx and Abu Dhabi Investments and HDFC to bring in money. If at all the government can, it can only tell LIC and SBI, if at all. How is this problem going to get resolved? 25,000 crores is there under 1 year tenor. And Mr. Kumar says that government is a very limited role here.
Sure. I mean, I think it's quite clear that ILFS would need some sort of extraordinary support, and it's not obvious that that sort of support will be forthcoming. So there are, I can't see any clear and obvious way out of this issue. So then when we think about the banking system, we would assume that a large part of this exposure will become NPL. Of course, the loss given default would ultimately vary, depend upon exposure is at what level to which project and what's its status. But as a first step, I think our base case is that most of it will end up in NPLs.
Okay.
Because we don't see an obvious path forward.
Okay. Well, actually, the loan amount, I think, is about 55 to 60,000 crores. The rest of them are ventures. So we have to, even if that is, something that banks are provided to date, and maybe they can sell off some of their loans. For the debt market, there is a here and now problem. I'll have to take a mandatory break. I'm coming back and posing that question to our debt market experts. How much more reverberations can the IL&fs debentures bring to the debt market? In a minute with my experts. Welcome back. We've been discussing with Amandeep Chopra of UTI Mutual Fund, Srikanth Vadlamani of Moody's, and Lakshmi Iyer of Kotak Mutual Fund about the possible reverberations that can be felt of IL&fs defaulting on some of the instruments. Amandeep, I want to come to you on that. The 55,000 odd crore of bank NPAs is one issue. That has to be restructured. But about 25,000 crore are short-term paper. They're debentures, maybe even commercial paper. Now, what happens? Some of them are, held by for instance, mutual funds. Are you seeing or are you hearing of redemptions at these funds?
Latha, not yet. I think not to that extent people are fearing. I think, the redemptions have more or less been very orderly. It just so happens that seasonally September quarter end is always a period where redemptions from mutual funds are a little bit higher given the quarter end pressures. But we're not seeing any significant outflows because of the Il&fs issue. I think the overall exposure within the mutual fund was much lower than what is out there with many other class of investors, particularly pension funds and banks. So to some extent, I guess, mutual funds have already been marking down their exposures in this entity. And I think that is more or less reflective of, the current stress and rating of Il&fs and its other group entities.
Okay. Yeah,
But if clearly no resolution is found, then I guess it will have implications for the broader financial markets because, we do understand that Il&fs has been classified as a systematically important NBFC. And 1 trillion rupee size balance sheet, consolidated balance sheet size is not very trivial.
No,
So,
it's not at all trivial.
Yeah,
I mean, I shudder to think whether any of those provident funds and pension funds have a problem. They're all big marquee funds. There is SBI Provident Fund and Pension Fund, which has some of these instruments. NPS Trust has it. General Insurance, GIC. These are all huge guys, and probably they can take a hit of even a few hundred crores. But my problem is dislocation in the debt market. Lakshmi, do you still fear that people will? There is a latent fear that some more companies may be, getting a AA rating, but they are not really AA. Will that fear continue to bedevil the debt market?
Absolutely. I don't think there is a doubt in that thought process at all. This will, lead one to paint, and its natural tendency to paint the entire category, say in this case, the NBFC sector, with a plain brush, because this is a situation which has still not found any resolution. And then what's happening is that multiple things are coming at the same time. A couple of bank stocks are also seen fall. So what's happening is that multiple things compounded with the fact that the banking is right now tight on liquidity. This is a typical period where mutual funds have redemptions. They prepared for it reasonably well, but these are events which are beyond one's realm of preparation. So I think market participants, whether it is mutual fund as credit evaluators, which anyways was in the past, will get further enhanced in the future, or those gatekeepers who evaluate such mutual funds schemes for making investments, or end investors. I think the entire coterie is going to now be slightly more circumspect going forward with respect to not only questioning if there is a particular rating, what is the logic or what is the process for that, number one, and not really want to take things at face value.
Oh, yes. That is the whole problem, not being able to take the reading at face value. Shrikant, the fears in the market, which people tell you, is that maybe not all these housing finance companies have lent only to retailers. Maybe they have done loan against property, or maybe they have lent to builders, and maybe there will be a genuine liquidity crunch for some of them. Two marquee names came and spoke to us today, Indiabulls Housing and DHFL, and they gave clear details that their near-term assets that will mature are more than their near-term liabilities. But, the market still worries that the housing finance companies in general and NBFCs NBFCs as well could have lent to loan against property, and therefore there is a chance that they will not be able to roll over their funds. Is that a legitimate fear?
I think we need to clearly differentiate between 2 points here. Point number one is that the housing finance companies, or for that matter, the broader retail sector, has been seeing very healthy credit metrics. Asset quality has been great. Growth has been fantastic. So it's all been good news. And the question is that, can that last? No, we don't think so. we do think that excesses, there are pockets of excesses being committed. LAP is one that you're pointing out. Growth has been very strong. They have been going down the credit curve. But it is not correct to extrapolate that and say that the things will get so bad that they're at the verge of default. I mean, the fact that things are getting worse is a cyclical thing. You know, the good news cannot continue for so long. Cyclical, there would be some change in the metrics. But I mean, we cannot conflate that with saying that just because we are saying things will get bad, we should not imply that things are so bad that suddenly they're facing massive solvency challenges.
No, a normal rise in yields will not have affected them. But now, because you have this 25,000 crore of Il&fs paper as well, you know, there can be redemption pressures and therefore things can get tighter than normal. Amandeep, would you think that if Il&fs 25,000 crore of near-term paper is not resolved immediately, this can create a problem? Do you think that regulators have to sit up, government has to sit up, and maybe even announce a line of credit to mutual funds or to NBFCs? Amandeep.
So, Latha, you've already seen, you know, like I said, initial sort of stress being built up around, you know, Il&fs defaults with what has happened over the last few days, and particularly today. You know, it's very clear if 25,000 crores of maturities till March 19, and largely, you know, short-term CPs are not provided, then clearly that is liquidity which is out of the system right now. And to fund that, you know, there will be repercussions because, one, you will see markets to some extent get tighter and squeeze out much tighter than where they are today because, one, you will not have the same level of comfort. You know, the biggest concern in such an environment is the loss of confidence. And just the way you were describing on how people are now suspecting, you know, even the AAA ratings of some financial sector entities. Most financial sector entities, whether it's NBFCs or HFCs, rely on borrowing to lend onwards.
Yeah.
The moment that liquidity, you know, is stopped, then clearly, you know, you see the issues being sort of blown out into a solvency issue. So how do they fund, you know, their subsequent growth or even disbursements that they have?
So the contagion, this is what we call contagion.
And then it affects every financial sector entity because if the cost of borrowing for, you know, company X goes up because of its liquidity concern, the cost of company Y is not going to be lowered down either. That's also going to go up by the risk premium, which any bond or a CP investor is going to look for from every subsequent financial entity is only going to keep rising.
Okay,
so I think it is going to be a contagion if, you know, you do not see...
if there isn't an external force that comes in and corrects this.
That's right.
Okay, and which only can be the government. Okay, I have only, I mean, actually I have no time left. So a one-sentence answer, Srikanth, Il&fs problem requires regulators, government to step in and force a resolution? Srikanth? Okay, I think I've lost him. Lakshmi, same question to you.
Sorry, can you hear me?
Yeah, just a one-sentence answer. Do you think this requires government regulators to intervene and be resolved?
Well, I think if an event of this size requires a government regulation, then maybe the Indian financial sector core strength itself is under doubt because...
No, I mean the Il&fs.
Big, it cannot be so big. I mean, it is not so big as well.
25,000 crores Il&fs near-term liabilities.
25,000 crores compared to what is the size of the Indian financial system. So the point is that if government intervenes at that level as well, that means there is a sort of a blanket guarantee to most financial institutions.
Okay.
Which is not good
so
for a medium
term. They should not
intervene.
is your point.
I'm just telling what happens if they intervene. I have no view on whether they should or not.
Okay. But if they do, okay, then the view will be that government is giving a blanket guarantee. Well, point taken, actually, out of time. Lakshmi, one-sentence answer. Do you think this requires external intervention?
I definitely think, I don't know who will intervene, but I definitely believe that there needs to be some external intervention, specifically from shareholding perspective.
All right. Thank you very much, Lakshmi, Srikanth and Amandeep for joining. Out of time. Thank you, everyone, for watching this show.